Well, good morning and welcome to another episode of CREDE Play Offense. Today, I am lucky enough to be joined by Anthony Delorenzo, a dear friend and work colleague. Anthony is a vice chairman and managing director over at CBRE, and we've been friends and work colleagues for years. And so, Anthony, thanks for joining us today. Appreciate you taking the time.
Really appreciate it. Thanks for having me.
So, would love to start off, with a little bit. Our business, as you know, it's all about people, and maybe talk a little bit, if you would, and don't mind, the introduction of, where you came from, where you grew up, school, how you decided to get into this business, and, why you are where you are today. And I look at it and go, real estate is one of those businesses that is people-centric and continues to be. So how does someone get to where you are in this industry?
Well, great questions. I mean, I think I'm one of those fortunate folks who knew one person in the industry, and that one person, helped certainly get me through in the door and to where I am today. And so a little bit of background, I grew up in San Diego. I went to college out in Arizona at the University of Arizona and was finishing up, and I knew one person in the industry. And it was a guy, Phil Voorhees, still a dear friend and partner of mine to this day. And he gave me the pitch on real estate, and I didn't know any better at the time, but I'm happy that he gave me that pitch. And it was one of those things where I started right after graduating in 2005 and have been here ever since. And so saw, the early years of doing runnership and watching the market just be on fire, and then, the GFC, and saw a lot of change happen. And so those were the formidable years that I think gave me and a lot of my friends and colleagues who are still here the foundation to understand or see what's going on now and to take hopefully advantage of it. And just through attrition and through a couple, I'd say, bits of luck is really the net of how I've gotten here and stayed here.
So talk a little bit. I mean, I always go back and like my internship as a runner. It's a lot of people don't even understand what that is or how you can take being a runner into, your organizational skills and efficiency of, overall business. Cause it's to me, it was one of the best training grounds. Cause I just look at like, it's not just dialing for dollars, but it's learning from what you're doing.
Yeah, and I think I'm taking a brokerage angle on the runnership question, and most people, they start there, and runnership in a glorified way of explaining is like you're an indentured servitude. You're the Swiss Army knife. They throw you something, and you got to catch it and run. And so that's cold calling, that's underwriting, that's writing investment highlights, that's making callbacks. It's everything, and it's coming at you from every different angle. And I think where most people, at least young brokers, come into this business think that the only way that they can create value on a runnership is by bringing in business. And listen, that's a very important part. But I think what a lot of people and why a lot of people don't last is they beat their head against the wall, and creating and finding business as a young person who doesn't really know much about anything is really hard. And I had a great mentor at the time who said, "Hey, listen, Turbo, I know you're ready to rock and roll and run full speed, but you really don't know anything, and you probably won't know anything for 5 to 7 years." And I remember at the time when he said that, I'm a millennial. I got that mindset where I'm like, "Oh, that guy doesn't know what he's talking about. I know everything." And sure enough, he was right. And so, having the perspective at the time to at least take a step back and realize, and having a team around me to let me maneuver was beneficial, because I realized you can create a lot of value for the team and your partners by not just cold calling and finding business, but for finding opportunities within the team to fill a need and a gap. And an example, I had a partner who's still my partner at the time, who was prolific at business development. I mean, he's the best in the business and had 30 years on me. And I would look sometimes at some of the tasks he was doing, and they were remedial, but time consuming for him. But I could have done it, learned, gotten it off his plate. And through months of seeing those kind of things, I would just take more from him. And that was a way to make his time more valuable, because he could be on the front end, but then also make my time more valuable because I was helping the team as a whole grow. I was learning through, just work that, and through some back and forth with him, and it served all of us better. And it was this kind of eye-opening thing where it was just, you can create value for a team in many different ways. And, I kind of expressed that to a lot of the young guys, not only on our team, but through the industry. It's like, hey, don't have a focus just on business development. Take a bigger picture approach and look around a little bit and find how you can make your overall enterprise more valuable by, not just business development.
You saw me chuckle with the term turbo. I had two mentors. One of them used to call me, he's like, you're like a little puppy running around the playground trying to, lick everything and pee on everything, but you really have no idea what you're doing yet.
Yeah.
But I had, when Russ started teaching me, that was my big aha moment where I went, wait, I'm supposed to do X, Y, Z, but here's a guy running billions of dollars and I can do whatever I'm doing. But if I can make his time more valuable and free up, the odds of me being respected and being valuable to him is massive compared to anything else I can do on a day-to-day basis for myself.
100%. Couldn't agree more.
Yeah. All right. Well, I want to get back a little bit to teams later, but so what are you seeing in the market? I mean, you guys cover a lot of different have covered all sorts of different asset classes over the years, and Bill is still a dear friend, and Voorhees is always creating different things. But I know you run a great team, and what are you guys focused on right now? What are you seeing?
Yeah, I mean, our niche has historically been, I'd say, in that mid-tier private capital, family office, in some cases institutional range, but in that 10 to $30 million segment of the market. And what I will say is, and the product types we play most in are on the industrial side and the office side. And I think everyone can attest, industrial still, the darling at the ball, albeit some cracks here and there and a little bit of slowdown, but still the appetite and the demand is absolutely there for that space. Financing's there, equity's there. I mean, it's still humming. And so we're busy still putting deals together in that regard. The office is, I'd say, where we spend most of our time. And contrary to what popular belief is, there is an office market, and a lot of it's still trading. And while in some cases the values are significantly down from where they were a few years ago, there's still a line of people who want to buy office and who still believe in office and are taking kind of different views of what to do with office. And so I'd say we're spending probably about 60% of our time, putting office deals together and bidding it out across the Western US. And, it's fun because it's not just the traditional, like it was, with one view in mind. Hey, it's a big office building, fix it up, push rents, sell it. It's different ways. It's, hey, can we find owner users? Can we do a residential conversion? Can we convert to, a different use like medical? And so it's, getting creative with it and finding those buyer pools who will also think creatively about it. And it's been a lot of fun.
Essentially we've got a lender client we're doing 5 assignments for right now on existing office of like, can we convert parts to, not a WeWork, but a hybrid WeWork? Can we do, ground floor retail out of, can we convert to, multi or hotel, or do we have to tear it down? And so, you're starting to see a lot of the creativity. And to your point, the basis is sadly enough back to where you can actually utilize the structures to do things. We feel that there's probably 30 to 40% of the office that needs to get torn down, and still 60% that is really good office for either office is pure office, class A, good class B. And then the rest is adaptable for, live work retail, hospitality, or even self-storage or data center. Is that kind of similar to what you're seeing?
Yeah, a good colleague and friend of mine up in LA, Todd Talaska, has a great saying, office isn't overbuilt, it's just under demolished. And, I think there's a lot of truth to that. And I think there's a number of different ways to look at the office market, depending on the stats and the white papers you look at. But if you just want to look at it from like where the vacancy sits, and vacancies risen nationally from like, I think pre-COVID, give or take, 9.5 to 13. But when you really dissect where that vacancy is, most of it, 80% of it, is in, what I think many of us would categorize as like the bottom 10% of the buildings within every respective market. And so, a lot of the problems are very isolated to certain buildings and locations. And I think, to paint office under one brush is the wrong way of looking at it, right? CBD office that's vertical, high rise with parking structures is operating much differently than, say, suburban, low rise surface park buildings. It just
Mhm.
is. And in many cases, those suburban, low rise surface park buildings are doing fine. In many cases, better than where things were in pre COVID from an occupancy and from a rent perspective. And so, I think you got to come into each one of those buildings and look at them differently. I think the adaptive reuse folks, I think it's a great strategy. We just sold one of those with Matt Carlson and Hunter Rowe down in San Diego last week. And that's the angle. It's vertical asset in downtown San Diego, beautiful building, and they're going to do an adaptive reuse. And I think it's going to work really well down there. That might not work well in different markets. And, you mentioned basis. Basis is key. And, you know, sadly, in many cases, we're at numbers that are far below where these same assets traded in the GFC. Forget adjusted for inflation or any other metrics, just straight dollars. We're below where those assets traded. So I think a lot of people, especially the high net worth family office community, look at this as an unbelievable time to buy some real trophy assets that a lot of people are scared of and lenders are scared of, but you can buy them at unbelievable bases that are going to be durable for, probably the next two cycles.
Yeah, and it's always amazing to me in our business how short our memories are, and yet how long our hold periods are. My partner Thomas worked for a family. They were the largest owner of land for office in downtown San Diego back pre GFC, and they flipped that and got into Walmarts for almost $22 a foot for per leasing foot. Or you look back and you go, okay, like we were over malled in 2015 and 16, and you couldn't give a mall away, but the bad malls were doing horribly, and the great malls were now it's retail's back to being a darling, and it's the highest per square foot sales in history.
Mhm.
So to me, we all need to remember that it is cycles and it's human nature. So yeah, office is down, but great real estate's great real estate, and you make a very good point there, because it's not. I mean, not everyone's going to work out of their house for the rest of their lives.
No, I mean quite the opposite. And I think there's a lot of excitement because you're seeing some of the big occupiers be very vocal about this return to work is real. People need to be in seats 5 days a week. And, I think that's a big driver. What's kind of also interesting is, you look at one of the last job reports that came out, and job growth was up, but when you really unpacked it, I think the lion's share of that job growth came from the government, and
Yeah.
the government hasn't been very vocal about pushing its people back. And so you want to solve some of this, return to work. It could be solved from the governmental standpoint, just pushing their people back into the office. And we're, as we sit today, about a week away from an election, so maybe some of that tide changes a little bit. And if that happens, I think people might surprise themselves on how fast the office market comes back. And when you look at back to the comment on the majority of the issues are in that bottom 10%, pick a market, and that bottom 10% is getting demoed pretty quick, whether it's for townhomes or apartments or industrial buildings, or you mentioned data centers. I mean, a lot of it's going away. And so, our markets are going to get tighter just from a demolition standpoint, and not many markets, very few. And so, because of that, we're going to see a tightening and probably an expansion of the workforce, from an occupancy standpoint. And so some of these reports that forecast 5, 10 years of supply, those reports might be very wrong very quickly. If things,
Yeah,
a couple
I'd be
things.
curious if you have a read on. I've always heard that if you average it, and of course all markets are different. Bethesda is different than San Pedro, but kind of globally, I've always stuck with 22 to 27% of all office occupancy is tied to government of some, not necessarily direct, but if you to your point of like going back to work, if the overall government went to their direct folks and their direct vendors that have to, GSA contracts, et cetera, that's the number I've always been told that is close to the entire office market across the United States.
I mean, I couldn't even guess what the stat is, but it wouldn't surprise me if it was close to that. Might even be higher if you think of all the private sector stuff that is tied to government related uses or contracts, it could absolutely be higher.
Yeah, interesting. Let's talk industrial a little bit. It's, for us, it's interesting when you start talking about where things are going. We've seen in all our forecasts is we're basically at the bottom for material pricing, and we've seen a lot of softening. We've seen, subcontractors back off their backlog, start to soften up. A lot of subs are, we're pushing 20% profit margins are now down to 10. And we've seen a lot of vacancy open up in, areas like Phoenix and Dallas, but a lot of the big bombers, million square footers, et cetera. Our focus on the development is shallow bay, light industrial, the small guys. Any overall trends you're seeing in the industrial market, or where people should start to play? Because it's, again, I'm forecasting a little myself, but it's like, I agree with you. Generally speaking, the market feels like it's about to start tightening up, and we've kind of hit bottom all the way around.
Yeah, and I mean, not to say all of it begins with activity and construction costs, but I mean, I think one piece that's been, I won't say noticeably absent, but is on everybody's wish list of things to improve is debt. And if we would have had this call about a month or so ago when the Fed dropped and everyone was hoping that things were going to get better and sentiment was very high. And I think a lot of things were already baked in at that point. But sentiment was strong at that point that, hey, we're turning the corner. Things are going to get cheaper. I mean, we've seen industrial cap rates probably compress, depending on what it is and where it is, probably 25 to 50 basis points, give or take, over the last, from, let's say, middle of summer to end of September, right? In preparation for hopefully debt getting cheaper. We sit today with a 10-year that's 50, 60 basis points higher than where it was 2 months ago. So that doesn't help. But I think to your question on where is industrial going, I think industrial's got a lot of room for improvement, from a cap rate perspective, if debt just starts getting more affordable. And it feels like we're right at that cusp of things happening that would help in that. And so between that, I think, the question, and this might help from a development standpoint, I mean, rents, unfortunately, I think are softening depending on the market. They've already softened in major markets where they saw. Now, let's take a pause. When we say they've come back 10, 15, 20%,
We're not where we were in 2015.
well, coming back 10 or 15 or 20% when they went up 100% over a 3 or 4 year period, we're still up 70 or 80% from where we were a couple of years ago. So let's keep some perspective. But I think, the challenge has been, we've seen rents that have posted 2 years ago that are now significantly above market. So there's this debate on where are they going? When do we get back? What's the time frame of doing so? And that's really the question on industrial.
And we're in, just to educate the listeners here, where are you guys focused with your teams there for industrial? Like San Diego, IE, Orange County, or out of state as well?
Yeah, and we're out of state as well, and so for our team, our core team of 30 members, we're really spread across the Western United States, playing in that middle market space. Now we have an institutional team of CBRE national partners that we do a lot with, and they're a national team, and so they're, as I look at it, really the barometer for the institutional markets, just because of the volume, the clientele, and the scale in which they transact. And we, in concert with one another, transact a lot together. We're sourcing a lot of the private capital, they're sourcing the institutional capital, and we're finding our way between. But like you said, every market's a little different. Phoenix is pricing different than Vegas, than San Diego, but we're touching all those markets.
And it's interesting that how trends have changed. I mean, we're seeing upticks in development and cost, in places like Indiana that have nothing to necessarily do with construction, but it's data center. And, you have every drywaller is now sucked up over there, or you're seeing, a continued onshoring from a lot of industrial development in Monterrey, Mexico, and coming up through San Antonio to Dallas. Is there any nuggets or trends that, kind of aren't your typical hub markets that you're focused on or looking to grow or people are looking at?
Yeah, I mean, you mentioned like Monterey and Laredo. I mean, I think there's there's the get in front of where the puck is going type markets that are looking at trade considerations, things like that. And absolutely, there's people running towards those kind of markets. The Midwest is another good example. I mean, we just sold a project in the Midwest that was, in my opinion, great pricing, but a great opportunity. I think some of the challenges and where we're seeing the migration, certainly of like private capital, is, and we saw this early on the apartment side, with some of the regulations, certainly out of California, rent control, eviction control, vacancy control, things like that, that kind of took some of the ability to operate your real estate out of your control, and really put it in the government's control. And some certainly private capital said, "Hey, I'm not feeling that," and they went to, I'd say easier municipalities to operate their business plans in Texas, Florida, Arizona, states like that. I think you're starting to see that a little bit on the industrial side. There was a bill that passed a couple of weeks ago, at the state level, that makes it a little challenging for development in California. And I think when you start looking, not only with that, with environmental regulation, which California is incredibly difficult with, California is a hard place to develop industrial. Now, the people who have it and it's already there, kudos to them. But a lot of the folks that have these infill sites that we're looking at iOS or redevelopment, it's a difficult place to navigate through. The folks that know how to do it, they're going to see great opportunity. But the folks who are new to these markets are probably going to stub their toe.
Yeah, I tend to agree. Well, going back to kind of our initial opener of like how you got into the business, what is it you're looking for when you want to add somebody to your team, or thoughts on, your kids are a little bit younger than mine, but as mine potentially come into the business, what should I be telling them?
I was having this conversation with one of my partners, in LA, and not to say it's simple, but it's attitude, right? I mean, like, you can teach a lot of things. You can teach people numbers. You can teach people like a little bit how to like negotiate and deal with people, but like attitude's something I just don't think you can teach. And whether people say it's attitude or grit or what, I think it's all the same. It's mindset. And I think people want to work with and be around people they like and that they enjoy being around. And what's remarkable to me, and we all know the people in the industry who I think we would all say, man, that person's a real pain and is pretty gruffy, but yet they're in the business. They've been there 30 years. And when the young folks, I think, get disappointed day in, day out, for because it's hard, right? You're cold calling, you're getting your teeth kicked in. But I always point to, like, listen, if there's people who are that difficult to work with who have made it in this business, imagine how better they would have done if they were actually pleasant to be around. So just be pleasant, have a smile, be responsive to people, don't get hard on people. And I think that to me is 90% of it, showing up with a good attitude and being pleasant to be around. The rest of
Yeah,
it,
and it's interesting your point, because it used to be like, oh, people wanted to come through Eastdale to be an analyst, or come through you guys. But it's like, there's so many different ways to get into our business. And you can be a math mind, you could be, just a grinder, but it's like, yeah, I agree with you. If you can show up and figure out how to not just make cold calls or not just run numbers, but to your point, have some EQ and take, responsibility off your boss's shoulders, you're already winning.
totally. Yeah.
Are you guys looking to expand your team at all as you look at 25 and 26?
Yeah, I mean, I think we're always looking to find the right people, and for us, it gets back to kind of that attitude, however you want to refer to a culture, attitude. I mean, that's the stuff that I think is the most pivotal piece. You could have the most prolific cold caller, numbers person, best business generator ever, but if that person's hard to be around or deal with in a team environment, we have a pretty sizable team, and when you add them all up, we have 40 members of our team. If you can't work well in a team environment and are pleasant to be around, I don't care who you are, how great you are, like, we just candidly don't want you. And so we're always on the hunt for those good team ads, whether it's in markets that we're already in or markets that we'd love to have a better presence in. And there's plenty of them across the West. So yeah, we're always on the hunt for really great talent.
Well,
And
and
it's everybody.
yeah, and I think it's interesting you bring it up. I mean, we've known each other for some time, and I would say that's, a lot of people say it, but everybody I've met on your team is not transactional. It's, you're really good getting to know the clients, both buyers and sellers. And it's like, why do you want to do a deal with you guys? Well, it's like, one, you dig stuff up, but two, I think you really understand the business plans and the desires behind the people of, the why. Why are they selling? Why are they buying? It's not just a 1031, but like, are they looking for this for their grandkids? Are they, anyway, maybe talk through that process a little bit of how you do your interviews of sellers and or buyers so that people can understand how you can help them, not just transactionally.
Yeah, I mean, I think you sort of referred to it. I mean, you just gotta. We're brokers. At the end of the day, we're service providers, and so as a service provider, you always, and I know it sounds cliche, but you kind of got to understand what your clients' needs are and try to solve for the needs, not your own. And I think the people that can sit there and take a consultative approach, an advisory approach to the clients, whether it's on the buy or the sell, and put that first, it's going to come off that with those clients that, okay, yeah, you're not just in it for a transaction and to, get a deal done. You're in it to try to advise them on what's best for them. And I think if you have that mindset, which I think most of the folks, if not all the folks, certainly on our team do, it's going to come off and the transactions are going to follow. And so I think when we're talking to folks, and I get a lot of people are sheltered about, broker asking questions about, their debt and their long-term plans because, they're probably thinking like, oh, we're just trying to figure out where the angle is, try to make a deal. I'm going the other way. I'm trying to figure out how to blow a deal up to maybe say, hey, it isn't the best time to sell your asset, or you should be looking at it in a different way. And so I think for the folks that, and I mean, we talk ourselves out of more deals than we talk ourselves into, because it might not be the best time to transact. And so a lot of what we're doing is just that, the why. Why are you selling? What are you going to do with it? Why do you want to do those things? Where's the headspace at? And, once we get a good idea of where people's motivations are, then we can really help, whether it's on the buy or the sell.
Yeah, that's great. Well, thank you for your time today. Any other quick nuggets as we go into 25 that people should know about or you're thinking about, or where's your headspace?
I'm fired up for 25. I mean, 23 was a little rocky, 24 similar. I'm really jazzed for 25. I think things are really starting to come together in all the product types. Again, we're office guys mainly, so I mean we're watching the retail guys.
You made it.
Yeah, totally. The retail guys have been fluttering around, being the product type that has, in many people's minds been the hard one to crack. And it feels like retail's back. And now we're looking at the retail guys envious, like, hey, maybe the office is right around the corner. And I truly believe it is. And I think we're in for a fun ride in 25 and 26. So we're eager and excited. But thank you for doing this. I wish more folks put together these kind of podcasts to just try to connect a large network of professionals. So thanks for including me on it.
Of course, if anybody's looking to buy or sell, how's the best way to find your team? Do you see like the CB's website or? Yeah,
or you can email me. I mean, my email and cell phone are always available. So my email is anthony.delorenzo@cbre.com. So, and you can find us online and websites, but we're happy to help in any way. Connect a dot also.
All right, buddy. Well, thanks again for the time and look forward to seeing you here in person in a couple of days.
Looking forward to it. Thanks so much.
See you.
Be well.
You've been tuning into the Real Estate Play Offense podcast with your host, Colby Durnin. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, CREDEgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.